Welcome to today's deep dive. I'm your host, and with me, as always, is our resident financial expert.
Hey there. It is great to be here.
So I want you to imagine something. Imagine you're doing exactly what you're told, right?
Yeah.
You balance your portfolio, you trim your winners, you buy the dips.
You're being the model investor.
Exactly. You're doing the financial equivalent of eating your vegetables. And for your good behavior, the IRS hands you a massive, entirely avoidable tax bill come April.
Yeah, which is just the worst feeling.
It really is. So today's deep dive is all about the hidden tripwires of portfolio rebalancing. We are pulling from this incredibly insightful article today. It's titled, 4 Tax Questions to Ask Before You Rebalance Your Portfolio.
It's a great piece. It really breaks down the mechanics.
Yeah, and our mission today is basically to figure out how a healthy financial habit can accidentally turn into a massive headache, and more importantly, how you can actually avoid it.
Because nobody wants a surprise tax bill.
Right. Okay, let's unpack this, because on the surface, rebalancing just sounds like standard financial housekeeping. It sounds harmless.
It does sound harmless. And honestly, the underlying logic of rebalancing is essential. I mean, you set a target for how much risk you want to take, right?
Like, say, 60% stocks and 40% bonds.
Right, exactly. But over time, the market moves. So if stocks have a phenomenal year, suddenly your portfolio is, 75% stocks.
Which means I'm taking on way more risk than I originally signed up for.
Exactly. You are now taking on significantly more risk than you planned. So rebalancing is simply the act of selling what went up and buying what went down just to get back to your original target.
Makes total sense.
But the source material highlights this major blind spot for a lot of investors. Thoughtless execution has inadvertent consequences.
Because of the taxes.
Yes, the moment you hit the sell button to rebalance, you are triggering a cascade of tax rules. So the goal of this deep dive is to equip you with the right questions to ask before you make those trades.
Okay, so the first question the article brings up is all about the geography of your money.
Geography is a good word for it.
Yeah, it's about looking at where this activity is actually happening before you even look at the numbers. To visualize this, I was thinking about the difference between a toll road and an all-inclusive resort.
Oh, I like that. What's fascinating here is that is a highly accurate way to look at the financial mechanics of different account types.
Right, so think of a taxable brokerage account as the toll road. Every single time you make a move, like every time you exit a stock at a profit, you're basically hitting a toll booth, and the IRS demands a cut.
They want their piece of the action.
Exactly. But individual retirement accounts, your IRAs, or your 401ks, those are the all-inclusive resort. The article notes that transactions within those accounts are entirely tax sheltered.
Yeah, and the mechanism behind that is based on how the government views retirement savings.
How do you mean?
Well, the IRS isn't tracking the individual trades you make inside an IRA because your tax agreement with the government is based on when the money crosses the boundary of the account entirely.
Oh, okay. Like when it goes in or comes out.
Right. So with a traditional IRA, you get taxed when you eventually pull the money out in retirement. And with a Roth IRA, you already paid taxes before the money even went in.
Right. But while the money is inside the resort, you can just move from the pool to the buffet.
Exactly. Meaning you can sell a stock that doubled, take the cash and buy a bond, and you do it all without opening your wallet for a toll. There is literally no tax form generated for internal shuffling.
So if I'm doing my heavy rebalancing, I should really prioritize doing it inside the all-inclusive resort whenever possible.
That is the smartest first step, absolutely.
But let's say I have to rebalance on the toll road. Like I'm in my taxable account, I have to sell a stock that has gone up. The article draws a massive line in the sand regarding how long I've owned that stock.
Ah, yes, the holding period.
Yeah.
So if you sell an investment that has gone up in value, you generate a capital gain. But the IRS treats that gain very differently depending on whether you held the asset for more or less than 1 year.
Right. So if it is under a year, it's a short-term capital gain.
And the tax hit on a short-term gain is brutal.
It really is. It's taxed as ordinary income, right?
It is. The government taxes that profit at the exact same rate as the salary you earn at your day job.
Ouch.
Yeah, the underlying logic here is that the tax code is basically designed to incentivize long-term investment in the economy, not day trading. So they penalize short-term turnarounds.
I mean, if you are in a high tax bracket, federal and state taxes could just eat up a huge percentage of your profit.
Oh, easily. You can easily erode the very gains that your rebalancing was meant to lock in.
So if I'm stuck on the toll road, right, and I absolutely have to sell to rebalance, am I just doomed to pay taxes?
Not necessarily.
Okay, because the article references fidelity here, outlining a concept that sounds like, I don't know, making lemonade out of financial lemons.
Tax loss harvesting.
Yes. If a sale in a taxable account creates a loss, you can actually use it to offset your gains.
Right, so if you are rebalancing a taxable account, you are inevitably going to realize some gains. But you likely also have investments in your portfolio that have lost value.
Because the market doesn't just go straight up.
Exactly. So selling a losing investment actively helps mitigate the taxes you owe on the winners. In fact, if you have no capital gains at all, the IRS actually allows you to use your investment losses to reduce your ordinary income.
Okay, but there is a cap on that, right?
There is.
Because the source specifically points out that Americans can only utilize up to $3,000 in net losses to reduce their ordinary income for the year.
Yep, $3,000.
Why is 3,000? I mean, that seems incredibly low if my portfolio took a massive hit, like if I lost 50 grand.
It's an important distinction to clarify, actually, because you can use infinite investment losses to offset infinite investment gains.
Oh, wait, really?
Yeah. If you made $50,000 selling a tech stock, you can use $50,000 of losses from, say, an energy stock to wipe that tax bill to zero.
Okay, that's huge.
Right. But if you have more losses than gains, let's say you just lost $50,000 overall in the market, the IRS puts a hard limit on how much of that stock market loss you can use to reduce the taxes on your W-2 salary.
And that's where the 3,000 comes in.
Exactly. They cap it at $3,000 a year to prevent ultra-wealthy individuals from using massive stock market losses to just entirely wipe out the taxes they owe on their standard income.
Okay, yeah, that makes sense. It stops someone from paying zero income tax just because their stock portfolio had a bad year.
Exactly.
And the article notes you can carry any excess losses forward to future years so you don't lose the deduction entirely.
Which is a nice silver lining.
But this leads us to the trap.
The trap.
The article cites Charles Schwab explaining the wash sale rule, and this rule basically says that if you sell an investment at a loss and you buy the same or a nearly identical investment too soon, the IRS disallows the tax loss.
Yep, you get absolutely no deduction.
And the time limit Schwab gives is 30 days before or after the sale.
30 days.
Wait. The 30 days after makes sense, right? Like, I can't sell a loser, claim the tax break, and then just buy it back the next morning.
Right.
But 30 days before, that makes no sense. I haven't even sold the stock yet. How can the IRS penalize me?
I know, it feels completely backwards. But look at the mechanics of what the IRS is actually trying to prevent here.
Yeah.
They designed this rule so you cannot fake a loss for a tax break while quietly maintaining your exact same market position.
Okay, walk me through that.
Let's walk through it. Imagine you own 100 shares of a company. The stock is down, and you really want that tax deduction. But you also believe the stock is about to rebound, so you don't want to actually get rid of it.
So basically, I want my cake and I want to eat it too.
Precisely. Now, if the before rule didn't exist, you could just buy a second batch of 100 shares today. So you now own 200 shares.
Okay.
Then tomorrow, you sell your original 100 shares at a loss.
Oh, wow. Because I still own the 100 new shares, my portfolio essentially never changed.
Exactly.
I'm in the exact same position I was yesterday, but I get to claim a loss on my taxes.
The IRS views that as a wash. The 30-day before rule prevents you from pre-buying replacement shares just to artificially harvest a loss on the old ones.
That is so sneaky, but I get why they do it.
Yeah, it creates a 61-day window.
Yeah.
It's 30 days before, the day of the sale itself, and 30 days after. During that whole window, you cannot acquire a nearly identical asset if you want the tax benefit.
So what happens if I mess up and trigger it? Do I just lose the deduction forever?
Well, if you trigger a watch sale, the loss isn't permanently gone. It just gets added to the cost basis of your new shares.
Oh, meaning I won't see the tax benefit until I eventually sell those new shares months or years down the line.
Exactly. It delays the benefit.
It basically forces you to take actual market risk if you want the tax reward. You actually have to be out of the stock for a month.
You do.
So the big takeaway here is you can't just blindly click rebalance without checking your transaction history for the last 30 days.
No, you absolutely cannot.
Which raises another really big question. If I have multiple batches of the same stock, what exactly happens when I click sell? Because here's where it gets really interesting.
Oh, I love this part.
Right, because I think most of us just look at our brokerage app, we see we own, say, 500 shares of company X, and we think of it as one big puddle of liquid, like we just scoop some out.
Yeah, but the financial plumbing behind the scenes is much more granular than that. You aren't scooping from a puddle. The article points out that you can actually choose which specific shares you want to sell.
Wait, really?
Yeah, every time you make a purchase, The brokerage records the exact price and date for that specific chunk of shares. In the financial industry, that specific batch is known as a tax lot.
A tax lot. Okay, I like comparing this to a wine cellar.
A wine cellar.
Yeah, let's say you own 50 bottles of the exact same wine, but you bought them over a decade. So you have a case from 2015, a case from 2020, and a few bottles you just bought last month.
Okay, I follow.
The wine inside tastes exactly the same. But if you decide to sell a few bottles, you don't just walk into the cellar in the dark and grab randomly.
Right, because the financial cost of those bottles, what we call the cost basis, is vastly different.
Exactly. You bought the 2015 bottles for $10 each. You bought the 2020 bottles for $50 each. Today, they're all worth $100.
Right.
So if you sell the 2015 bottles, you have a massive $90 taxable gain per bottle. But if you specifically grab the 2020 bottles, your gain is only $50.
Which is a huge difference.
You are minimizing the tax hit just by telling the broker which identical item to sell.
It's a great analogy. And brokerages actually have a default method for handling this if you don't specify. It's usually first in, first out, or FIFO.
FIFO. Okay, so that means they automatically sell the oldest shares first.
Correct. Yeah. But the problem with FIFO is that in a rising market, your oldest shares are almost always the ones with the absolute biggest taxable gains.
So by doing nothing, you're basically volunteering to pay the maximum possible tax.
Exactly. The article strongly suggests taking the wheel and selecting specific tax lots to minimize that gain.
But, and this is a big but, the source pulls a critical administrative detail from Wells Fargo advisors. This specification must be done before the settlement date.
Yes. The settlement date.
I really want to spend a second on this because I think settlement date sounds like financial jargon that people just gloss over, you know?
Oh, totally. But it is the single most important mechanical deadline in trading.
How so?
Well, when you open your app on your phone and hit sell, the screen immediately updates, right? It looks like you have cash instantly.
Yeah, the balance just pops up.
Right. But that is largely an illusion. It's basically a courtesy provided by the broker. Behind the scenes, the trade is executed, but it has not actually settled.
So what is actually happening in the plumbing during that delay?
The transaction goes to a central clearinghouse. This is where the legal ownership of the shares is officially transferred to the buyer, and the actual cash is transferred to your broker.
Okay.
And under current rules, this process takes time. It's typically one business day after the trade, known as T+1.
Okay, so during that brief window, the trade is pending.
Yes. But once that trade settles, the ledger is locked in stone.
So if I sell my stock on Monday, and then on Thursday, while I'm doing my accounting, I call my broker and say, hey, make sure you sold the batch from 2020, they can't do it.
They absolutely cannot. Once the settlement date passes, the data for your official 1099-B tax form is generated based on whatever default method your account was set to.
Wow.
Yeah, you cannot retroactively change a tax lot after the clearinghouse finishes its job. You have to specify the tax lot during the transaction.
Okay, so picking specific tax lots makes a lot of sense if I absolutely have to sell. But frankly, tracking settlement dates, digging through cost basis history, and monitoring 61-day wash sale windows, it sounds exhausting.
It is a lot to manage.
Is there a way to rebalance my portfolio where I don't have to sell a single share and trigger this whole IRS microscope in the first place?
Actually, yes. The source material presents a fantastic alternative, which is rebalancing with cash flow.
Cash flow.
Yeah. You don't have to sell your winners to rebalance. You can just buy more of your losers until the percentages balance out.
Sure. I mean, adding fresh cash from my bank account to buy the underweight assets avoids the tax hit entirely because I'm not realizing any gains. But what if I don't have a pile of extra cash lying around to just inject into the market every time my portfolio drifts?
Well, if we connect this to the bigger picture, this is where we look at the natural mechanics of the portfolio itself. Your investments are likely generating their own cash flow.
Oh, like dividends.
Exactly. Many mutual funds, ETFs, and individual stocks pay out dividends or distribute capital gains throughout the year. And for most investors, these are set to a DRI, a dividend reinvestment plan.
Right, so when the cash hits the account, the broker automatically buys more shares of the exact same fund that paid it. Which means, if a stock is already taking up too much of my portfolio and it pays a dividend, auto-reinvesting is just making it even more overweight.
Exactly. It's making the imbalance worse. So the article suggests turning off the automatic reinvestment.
Just turn it off entirely.
Yeah. You let those dividends pool into the cash sweep account. Then, you deliberately deploy that pooled cash to purchase your underweight holdings.
Oh, I see.
You are using the portfolio's own natural exhaust to steer it back on course.
But wait, if I turn off auto reinvest and hold the cash, even for a day to rebalance, doesn't the IRS tax that dividend payout?
In a taxable account, yes.
Yeah.
But here's the key. Those dividends are generally taxable to you either way, whether you automatically reinvest them or redirect them manually.
Oh, right.
You are going to pay tax on that dividend regardless. So by redirecting it, you aren't creating a new tax event. You are just putting money that is already moving to better use.
That is incredibly elegant. You get to fix your portfolio allocation without ever hitting the sell button.
Precisely.
It requires a bit more active monitoring than just setting everything to autopilot, but avoiding unnecessary capital gains taxes over a lifetime of investing is massive.
It really adds up.
Okay, let's recap the 4 core questions you need to ask yourself before you hit that rebalance button.
Let's do it.
First, check your geography. Are you on the toll road of a taxable account or inside the tax-sheltered, all-inclusive resort of an IRA?
Crucial first step.
Second, if you are selling at a loss to offset gains, are you about to trigger a wash sale? You've got to check that 61-day window around your transaction so you don't accidentally disqualify your tax deduction.
Watch those 30 days before and after.
Third, if you have to sell a winner, go into the wine cellar. Specify the exact tax lot that minimizes your gain and ensure you do it before the clearinghouse locks the ledger on the settlement date.
Don't just accept FIFO.
And finally, consider if you can rebalance without selling at all by redirecting the natural exhaust, the dividends that your portfolio generates.
Yeah, understanding these 4 mechanisms fundamentally changes how you interact with your investments. You move from just reacting to a pie chart to proactively managing your tax liability.
Now, before we close this out, I need to read the editor's note included in our source material because it is crucial. This deep dive is for informational purposes only and does not constitute financial or tax advice. Investing involves risk, including the possible loss of principal. Always consider your individual circumstances and consult with a qualified financial or tax advisor before making investment decisions.
Very important to keep in mind.
We can explain the plumbing, but your house is unique.
Mm-hmm.
So what does this all mean? To me, it means that standard financial advice often comes with an asterisk. Rebalance your portfolio is great advice, but if you don't understand the tax mechanics behind the buttons you are clicking, you are volunteering to pay more than your fair share.
And that leads to a broader, final thought for you to mull over. We have spent this entire deep dive analyzing the tactical execution of getting your portfolio back to its target balance.
Yeah.
The goal of rebalancing is to faithfully maintain a predetermined strategy. But as tax laws evolve, as the market shifts, and most importantly, as your own life stages change, how often do you stop to ask if the target itself needs to change?
Oh, that's interesting.
Are you spending hours perfectly, surgically, tax-efficiently balancing your portfolio toward a strategy that no longer fits the life you are living today? Perfect execution of an outdated plan is still a failure.
That is a phenomenal point. You could be meticulously avoiding the toll raids, optimizing the wine cellar, and tracking every settlement date, but if you are optimizing a growth strategy when you actually need capital preservation, you are just missing the forest to the trees.
Exactly. The mechanics matter, but the destination matters more.
Keep asking the right questions, and we will catch you on the next deep dive.